But naturally, we want to change up the order a bit. But when considering gold mining investments, one often thinks, okay, want to have some exposure not only to different stages for diversified portfolio, but also to different companies and projects. So we want to address some investor considerations specific to royalties. And I know that Randy had touched on this as well. And we're happy to share this presentation from Elemental Altus' president and CEO, Frederick Bell, who's also a member company of Discovery Group. I would have loved to call Fred to do this in real time and have him speak in person, but I think it's about 1 a.m. for him, and he would have been really, really mad, and his wife would have been mad, and probably the baby would have woken up. So I'm just going to play this, and if you guys have any questions, you can reach out to Fred whenever you get a chance.
Hello, everyone. I am Frederick Bell, the CEO of Elemental Altus Royalties Corp. I'm going to give you a quick 2-slide presentation on the royalty model and why it's such a good model, and really for investors, you should look to get some exposure in your portfolio. So first off, the benefits to investing in the royalty model. The most important one is diversification. You can get diversified early on. And to give you an example, we started with one royalty in 2017 producing. We now today in 2023, we have about 10 producing assets that will be growing next year. And we're continuing to build out the portfolio. So we have approximately 80 assets now that we have royalties or streams over in our portfolio. So you can really diversify far more. And if you look at us and our market cap versus some of the mid-tiers, $1 billion to $5 billion market caps, and they might have 5 producing assets, and we already have more. So that diversification is a key risk mitigation option. It also, the fact that you can get royalties on producing assets, it means that you can generate revenue in the royalty model far quicker than you can in most other parts of the mining industry. And I worked starting off in a junior exploration company to begin with in Australia and in Africa, and I saw the timelines of years through exploration and permitting timelines getting longer. So one of the attractions for us starting Elemental Altus Royalties at the beginning was the ability to get producing assets and diversified revenue early on. And the third point, which is probably very pertinent in today's market, is you get top-line exposure. So generally speaking, you're talking about net smelter return royalties or gross revenue royalties, which come off the top line with a few allowable deductions. And that means that you don't have the same exposure to capital costs and operating costs. And so what you are seeing, I think, in the last 2 years is you've seen a lot of inflation in costs, which has eaten into the margins for miners. And as a royalty company or streaming company, you don't have that same exposure. So that is another great benefit of the model. Scalability is the fourth point. And I think for us, talking to the fact that we've grown, I think, at a sort of 70% rate in terms of revenue growth year on year since 2017, should give you an idea for sort of how fast you can grow the model. And there are plenty of examples out there of companies in the royalty and streaming space that have managed to really exponentially grow in terms of scale. And you don't have to grow your team at the same rate. So we're a pretty small, lean team now, and I think we could probably double in size and not have to expand our team a lot. So that's another benefit. And then the last one, and this is one of the most important, is the optionality you get on exploration success. And exploration success might be the biggest point, but you're also looking at technology improvements. You're looking at optionality in terms of throughput increases, production increases. So you are really getting yourself optionality on a whole host of diversified projects going forwards. And that's one of the key to the royalty model. So what do you need to be successful, and what are you trying to avoid and look out for when you're doing this? So I think in terms of what you would like to get, and probably one of the most important points is high quality operators. And the biggest maybe strength of the royalty model is not having to operate the assets yourself. The weakness, conversely, can be that you are dependent on the operators. So for us, we have the operator as one of the key criteria when we're looking at new opportunities. Uncapped royalties, you can have step downs in the royalties. You can have structures that the rate reduces over time, but generally speaking, you're wanting an uncapped royalty to give yourself optionality going forwards, and also to account for some of the royalties and deals that won't work. And you need that optionality to balance out that risk. Generally speaking, we like the royalty to cover the whole area. Otherwise, you have displacement risk, and the mine can be continue to operate, but just not in your royalty area. And that also means it can be harder to model, particularly if it's a private company and not a public operator and the guidance isn't there. So generally speaking, it's helpful if it's a royalty that covers a whole license and you don't have that displacement risk. Allowable deductions, and that is what can come off the top line. And yeah, there's a big difference between a gross revenue net smelter return royalty and a net profit interest. And allowable deductions generally are pretty small, but they can be unique to each royalty agreement. So really important to check that. And then security, and this can be security in the land. In some jurisdictions, Canada or Australia, that's an easier process to do. And some less mature mining jurisdictions, the mining code just isn't sophisticated enough to account for you to do that. So what kind of security you can get, that's really important as well to protect you on the downside. In terms of red flags to look out for, capped royalties, and that can be caps on production, it can be caps on the dollar amount you receive, time limits or expiry, the royalty can fall away at a certain point if it's not in production. Again, unique to each agreement. Partial deposit coverage, we touched on earlier about having royalties that don't cover the whole project. Operator buybacks, again, it's not uncommon to have buybacks on a lot of royalties. One of the downsides is obviously it can limit your upside. You get all the same downside risk, but if it goes well, it's very likely the operator will buy it back. So generally try and avoid that. And then first right of refusals, and this is probably more linked to third-party royalties in particular, but that's where we have done a number of transactions and right of first refusals where you put an offer forward and then maybe the mining company that operate the mine have the first right to buy it back. So a few things to watch out for there. In terms of elemental Altus specifically, I think having done a high-level overview, a few highlights here. We've done 8 transactions so far in 2023, so it's been a very busy year for us. And most recently, we bought a royalty on Arizona and Sonoran's Cactus project, copper project in Arizona. We created, I should say, a royalty on the Diba project, which is now part of Allied Gold's Sadiola mine in Mali, and should be the Diba project specifically, should be coming into the mine plan in H1 next year. And we also bought a royalty on it should be Teco's Pickle Crow in Canada. We did 1 or 2 producing royalties as well. We increased our stake in a syndicate on Caserones, which is a copper and molybdenum mine in Chile that Lundine's acquired majority stake in this year. And in terms of our portfolio commodity mix, we're mostly precious metals, 70% gold, and copper is the second largest commodity at about 30%. And as I mentioned earlier, we're on track for about the midpoint of guidance is about 17 million US. And I think we're on track for that in 2023, which is about a 60% increase on last year. And we'll be putting out guidance for 2024. But again, should be a pretty good growth just from our existing portfolio without any other acquisitions. So what's driving that is I think 2 key assets, and that's Bonikro and Diba. And Bonikro really starts to ramp up from the royalty area at the end of this year. And then Diba, which as mentioned, comes on at the beginning of next year and should generate substantial revenue for us going forwards based on what Allied have guided. But also we have some milestone payments with that going into production. There is a PFS coming out on the Cactus royalty, which we recently acquired, that is scheduled for Q1 2024. And then we're actually in a pretty strong position to make new acquisitions. We're cash flow positive. We have about $10 million US in the bank. We have up to 20 million US currently on our credit facility we can draw as well. So we're continuing to look at new opportunities, and I think in this market we're seeing a lot of deal flow. And that is the summary really for the royalty model, and also a quick intro to Elemental Altus Royalty Corp. So thank you all for your attention and enjoy the rest of the evening.